To answer your question, when there's a concept that you're having trouble financing because you're getting pushback from a lender, the biggest thing to do is to find a lender that likes that vertical. So that's what we do. We identify lenders that like that franchise concept or that vertical. Maybe they haven't financed this particular concept, but they've done others in that vertical. So that's the real key. We do have third-party companies we work with that can help you prepare the business plan, or there's free resources like score.org and also the small business development centers. They have a CAT team there, and they'll actually for free help you put together your business plan and projections to make it easier. The best part of it is if you have a little bit of time, granted you don't have to close next week, there's a lot of hungry lenders out there that can utilize your compensating factors to approve the loan at the terms and leverage that you want.
Hi, Beau. My partners and I have been working with a local bank trying to get SBA financing. We are getting pushback from the lender saying that although the franchise is in the SBA franchise directory, they only have 13 franchisees and they're wanting us to come up with more down payment. They say this is a higher risk. Any ideas or solutions that may work for us? Thank you, Nate.
So Nate, and so the big thing on this, Nate, is that's accurate. We've talked about this on a previous episode, and it's an emerging franchise concept. Well, I'm thinking it's emerging. It could be around for 15 years. It just is slow growth and not a big franchise, right? But so at the end of the day, depending on what industry, it's going to be scrutinized because, listen, it doesn't have a proven record. If there's a franchise concept that has 1,000 units, right, they're established. Now, you doing your due diligence, you're going to jump into the FDD and see if there's any lawsuits. You're going to go through. There's 23 points on the FDD. You're going to go through those and make sure whatever concept you're looking at is kosher, essentially. But to answer your question, when there's a concept that you're having trouble financing because you're getting pushback from a lender, the biggest thing to do is to find a lender that likes that vertical. So that's what we do. We identify lenders that like that franchise concept or that vertical. Maybe they haven't financed this particular concept, but they've done others in that vertical. So that's the real key. So the problem, what I see often is that you're going to go to one bank, your local bank, and you're going to, put your application in, and you're going to like gotta be at their mercy. Whereas as you work with a commercial mortgage advisor, we take it to multiple banks. Now, it doesn't mean we're submitting a full file, but what it means is we're having a high level conversation to multiple banks and non-bank SBA lenders, and we're trying to figure out which one of these banks is the most likely to move forward with this with the highest leverage and the best rate. And typically the rates are Wall Street Journal Prime plus your margin. The margin is negotiable. The Wall Street Journal Prime is a floating rate that's not negotiable. You put those together, that's your fully indexed rate. So our job as a commercial mortgage advisor is to navigate you through the process, find the right lending institution with the highest leverage. Typically, not always. Some people have a lot of money and they put more down. But we want to get you the best deal with the best margin and make it a win-win. So that's what we do. And the best part is that we don't charge you a fee for that. We're actually incentivized to bring deals to these banks because they want more SBA deal flow, because a lot of banks that are in the industry, they like making SBA loans because a portion's guaranteed. So it's a win-win for you. It's a win-win for me. I get more business, and it's a win-win for the bank that we work with. So feel free to book a call below. We can discuss the project in detail and see what we can do for you.
This one comes from Maya. She says, "Hey, Beau, what are the best options to purchase a building that I'd like to open a restaurant in? I do have restaurant experience. I've been in restaurant management for 16 years. This would be a non-franchise restaurant, meaning independent."
Okay, so you're in the business for 16 years. This is your first this would be your first business that you're the owner of. So you have the experience. You want to buy the building and then open a restaurant. So based on your experience is good. So that's great. You have a long history of working within this industry. Then it's going to come down to your ability to come up with the equity, the cash injection you need for the down payment. and then to put it together a business plan and 3 years of projections, because that's what the banker's going to want to see. They're going to want to see 3 years of projections and a good business plan. We do have third-party companies we work with that can help you prepare the business plan, or there's free resources like score.org, and also the small business development centers. They have a CAT team there, and they'll actually for free help you put together your business plan and projections to make it easier. But based upon you having good credit, the equity to put in, or the ability to get the equity injection, which is typically on a startup about 15% of total project costs, it sounds like it's feasible. Most likely you're probably going to do an SBA 7A, just for the fact that you can build in more working capital and employee salaries in, and you'll get more leverage in the deal than doing a 504. A 504 would be good if you wanted long-term debt and it was a more expensive purchase for the actual real estate, but I think 7A would be the option. This is the kind of stuff we would go through as we're doing our due diligence, so feel free to book a call below and we can discuss this acquisition, this business startup financing. Thanks for the email.
All right, this one comes from Patricia. It says, "Hey, Beau, I am looking at purchasing a restaurant that's been in business for well over 20 years. I don't have any restaurant experience, but I have owned my own small businesses over the last 25 years. One banker I spoke to said his bank won't finance any restaurants unless the owner buyer has experience in the restaurant industry. Is there a workaround for this? Thanks a bunch."
So, Patricia, so yes, every bank's going to overlay differently. We talk about this all the time. Some banks say, listen, if you don't have any restaurant experience, we're not going to make this loan. That's an overlay. You have business experience. Now, granted, the restaurant business is a tough business, but you're buying an established business. You're probably going to have key personnel that are still working in the business when you take over. So, listen, there's a lot of banks, a lot of SBA participating lenders out there, and I'm sure we can find and navigate and find one. So like, we already know that it's going to be an issue, right? Like, even if this wasn't an issue and I was talking to you for the first time, said, hey, I want to buy this restaurant, we know there's going to be some pushback. So what do we got to do? We got to build up the compensating factors. What are the compensating factors? Well, you've worked 20 years. You've owned 3 businesses successfully. You're an entrepreneur. You have great credit. You have reserves. You have a lot of equity in a house that's probably going to have a lien on in second position. So those are compensating factors, right? We want to build the story. I want to ask these questions up front, right? And it's like a cup of coffee. Without anything, it's a black cup of coffee. We want to put the cream, the sugar in, we want to stir it, we want to get the whole story, and then we bring it to the right bank or non-bank lender, and that's how we get these things approved. So it's not uncommon to have pushback from the bank and them wanting more equity, but the best part of it is if you have a little bit of time, granted you don't have to close next week, there's a lot of hungry lenders out there that can utilize your compensating factors to approve the loan at the terms and leverage that you want. So hope that helps. Book a call below. Happy to discuss in detail. Thanks so much for your question.
Hi, this is Beau, host of the Investor Financing Podcast. Are you a real estate investor with properties and you're trying to figure out how to refinance or grow your existing real estate business? Need some clarity and a game plan for moving forward? I'm offering a free strategy call where we dive deep on your real estate investing goals. I'll help you come up with a strategic finance plan that will help you get to where you want to go. Whether you've got a portfolio of 30 properties or you're starting out with your first property, I have a framework that has helped many investors grow. If you're interested, book a call below in the Calendly link.
Hey guys, Beau here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.